If you want to leave your kids your assets without the IRS taking a huge chunk, you've probably seen all the social media influencers who say you can do just that by forming a revocable living trust. It is too bad that all they did was take legal jargon and jumble it into a sentence that is dead wrong, because a revocable trust does not help reduce tax. So in this video, I'm going to go through the actual tax law so you can learn what is truly required to protect your assets from tax on inheritance. And if you don't know me, I'm Jasmine DeLucci. I'm a tax attorney, CPA, and enrolled agent. My day-to-day is actually running my CPA firm and my tax law firm. But I started posting on social media and created a free tax law community after a decade of practicing tax, because real tax help with actual tax law should be available to everyone. In this video, we'll cover the following. So the first is the actual tax law on inheritance and revocable trusts. The second is the tax impact of gifting assets to your children versus leaving them through inheritance and when it makes sense to do each. And the third is how to protect your children's step up in basis when they inherit your business or real estate based on tax entity type, because yes, the type of tax entity matters. So number one, the actual tax law on inheritance and revocable trusts. IRC 1014 provides us our step up in basis statute. It says the basis of property in the hands of a person acquiring the property from a decedent, so a person who dies, or to whom the property passed from a decedent, shall be the fair market value of the property at the date of the decedent's death. So there's nothing about trust in the statute. You can die with a will, without a will, with a revocable trust, without a revocable trust. The asset will pass from your estate at death at fair market value, which, by the way, can also be a step down in basis if the property is less valuable than it was at the time of purchase, like stocks that have lost value and not yet been sold. The reason revocable trusts are still usually recommended is because they help with avoiding probate, which is the legal process to distribute a decedent's estate, and can have expensive attorney's fees associated with probate, and also privacy with the distribution of assets. And honestly, there may be more reasons, but they are not tax reasons. In fact, what we know about revocable trusts from a tax perspective is that under IRC 671, the income tax for the person who contributes to the trust, the grantor, still reports all income, deductions, and credits as if there was no trust and everything was still owned personally. A revocable trust is what we call disregarded for income tax purposes. So the general rule is that revocable trusts are often good to have, but not for tax reasons. All right, number two, the tax impact of gifting assets to your children versus leaving them through inheritance. This one does matter, and it's likely the reason people online started thinking that revocable trusts had a tax impact, since they started conflating that concept with gifting versus inheriting. So we already covered what happens when you leave assets through inheritance under IRC 1014, which is that your children get a step up or a step down in basis to match the fair market value at date of death. Now, what happens when your children get a gift is IRC 1015. Instead of fair market value basis, they get what we call carryover basis. They step into the shoes of the giftor. So the statute reads, the basis shall be the same as it would be in the hands of the donor or the last preceding owner by whom it was not acquired by gift, except that if such basis is greater than the fair market value of the property at the time of the gift, then for the purpose of determining loss, the basis shall be the fair market value. So this means that the basis you hold as a parent will be transferred to your child. Okay, so if you bought your house for $100,000 and made $50,000 of improvements over the years, then your child steps into your shoes and gets the tax basis of $150,000 at the time of the gift, even if the home is worth more than $1 million. So the exception is if your house has gone down in value and is only worth $100,000, in which case it is the worst of both worlds, because your child will not get your tax basis of $150,000 and instead will get a fair market value basis of $100,000, only in a situation where it's adverse. So a few rules to go by. The first is inheritance works well for assets that have increased in value and will not be sold before you die. So very often real estate. Two is gifts can work well for assets that are going to be sold before you die, because there are many situations where a gain on sale would be taxed at a better rate if your child is holding the asset at the time of sale. And three, inheritance and gifts do not work well for assets that have gone down in value. Ideally, you want to capture the loss by selling the asset rather than giving it to your children through gift or inheritance, because in both cases, your child is not going to be able to take the tax loss that you accrued while you owned the property. property. Now, these are the tax considerations, okay? You still want to keep in mind economic considerations. So for example, even if something's gone down in value and a gift or inheritance would be an adverse tax result, if you want to keep that asset in your family and not sell it, you should do that rather than selling it just for tax purposes. So finally, we're at number 3, how to protect your children's step-up in basis when they inherit your appreciated business or real estate based on tax entity type. This one gets a little bit technical, so it's just helpful to understand at a high level. So here I'm assuming you have an asset like a business or real estate that has gone up in value and you want your kid to have it. We just covered that it almost always makes sense to leave an appreciated asset that you're not going to sell before your death through inheritance and not as a gift. But how do you make sure your kid gets the step-up in basis based on tax entity type? The first is as a sole proprietorship, okay? This one's easy. The assets get a step-up in basis directly. Done, okay? So if you have a single member LLC taxed as a sole proprietorship that holds real estate or other assets, your kids should be good to go. Second is a partnership, okay? This is more complicated. The assets inside the partnership only get the step-up in basis directly if your kid makes a Section 754 election on the partnership return in the year of death. Otherwise, only the basis in the partnership interest gets the automatic step-up, not the underlying assets like real estate. Third is corporations, both S and C corporations. Also a little bit complicated. So the stock gets the automatic step-up in basis, but the underlying assets do not. There's also no election that can be made for the underlying assets to have a step-up in basis. So first, this is one of the reasons it's not as good to have real estate inside a corporation, but there is an option for you. If your child liquidates the corporation in the same year as selling the asset, then the two can offset in the same year. For example, there's a piece of real estate in a corporation with the basis of $0 because it's fully depreciated. The fair market value of the property and the stock at death is $500,000. That means your child gets a step-up in basis of the corporation's stock to $500,000 if your child then sells the property for a $500,000 gain and liquidates the corporation in the same year. There's a capital gain from the real estate, but also a capital loss from the stock, and you get the same tax result as if there had been a step-up in basis in the underlying asset, which is the real estate. Whew, okay, that last one is not a simple concept. A lot of accountants are also very unfamiliar. So most important to know is that the tax entity type does matter for tax planning when leaving inheritance to your kids, and your kids will likely want to hire someone to help them at that time. And if you want more actual tax law, then join my free actual tax law community where you can get free tax help, free IRS strategy, free monthly workshops, and a community board with free Q&A, because real tax help with actual tax law should be available to everyone. And as always, for actual tax law from a tax attorney, subscribe.